Operating an unregistered business in Hawaii carries an invisible, systemic risk. A single mistake can trigger a chain reaction that consumes everything you own. The default legal status for anyone who starts selling a product or service is the sole proprietorship. It is a legal zero-barrier state. In the eyes of the law, there is absolutely no distinction between the human operator and the business itself. The math of this structure is unforgiving. If a customer slips, a client sues, or a debt goes unpaid, the liability does not stop at the business bank account. A single lawsuit can legally liquidate your personal savings, your vehicles, and your private home to satisfy a judgment. The alternative is the entity shield. This is a structural barrier, engineered using Hawaii state statutes designed to absorb that liability on your behalf. Permanently severing your personal wealth from your business liability is the non-negotiable first rule of entrepreneurship. Without that separation, every business transaction carries the full weight of your personal net worth. Building this shield requires a chronological execution. We have to select the optimal entity structure, register it properly with the state, establish airtight internal governance, and build out the correct tax architecture. A recognized legal entity is not a title you give yourself. It is a mathematical and legal firewall that you must build, block by block, following specific statutory guidelines. By executing this specific 6-step blueprint, you transition from a legally vulnerable individual into an insulated, scalable enterprise. The baseline option for most founders is the Hawaii Limited Liability Company, or LLC. It provides a solid liability shield, operational flexibility, and pass-through taxation, meaning the profits pass directly to the owner's personal tax returns. We can contrast the LLC with the C-Corporation. This chart tracks a $100 profit through a C-Corp pipeline. Unlike the LLC, the C-Corp is taxed as a separate entity. The profit is hit with a corporate tax before it ever reaches the owner. When the remainder is distributed as a dividend, the shareholder pays taxes on it again. This is the penalty of double taxation. Founders typically absorb this double taxation penalty for one specific reason. They intend to raise institutional venture capital. Venture funds require the rigid, easily transferable share classes that a C corporation provides. Then there is the S corporation. An S-Corp is not a completely separate state entity type that you register in Hawaii. It is a federal tax classification that an existing LLC or C-Corp elects by filing a specific form with the IRS. Electing S-Corp status allows owners to execute a powerful tax arbitrage strategy. Standard LLC owners pay a 15.3% FICA self-employment tax on all their profits. S-Corp owners legally bypass this by splitting their income. They take a W-2 reasonable salary, which is subject to FICA, and take the rest as distributions, which bypass that 15.3% tax entirely. Hawaii also offers an elective 9% pass-through entity tax for S-Corps, allowing the business to pay state income taxes at the entity level, which can create additional federal tax deductions for the shareholders. Selecting the correct entity structure at inception dictates the mathematical ceiling of your lifetime take-home profit. The structure decides the tax, and the tax decides the profit. With the structure selected, we transition to tactical execution. In Hawaii, this happens through the Department of Commerce and Consumer Affairs, or DCCA. The first requirement is to query the state's Hawaii Business Express database. Your chosen business name must be entirely distinguishable from any existing entity on record. You must designate a registered agent. Hawaii statutes enforce strict rules here. The agent must have a physical street address within the state. P.O. boxes do not qualify, and they must be available during standard business hours to accept legal service of process. Once the agent is secured, you submit the precise filing instruments. For an LLC, you file Form LLC-1. For a corporation, you file Form DC-1. The state exacts a specific toll for this registration, a $50 base filing fee, plus a mandatory $1 state archive preservation fee. You pay $51 to exist legally in the state of Hawaii. Mastering this portal and securing your filing date turns a theoretical business plan into a legally recognized active operator. Securing DCCA approval puts your name in the state database. It is entirely insufficient to guarantee your liability protection will hold up in a courtroom. If you are sued, a plaintiff's attorney will immediately attempt a maneuver known as piercing the corporate veil. If a judge agrees to this, the court strips away the entity shield, exposing your personal assets to the lawsuit. The primary trigger for a shattered veil is commingling. If you use the business debit card to buy personal groceries or pay business vendors from your personal checking account, the court will determine the business is a sham and the shield will fail. To prevent this, you must apply for a free Employer Identification Number, or EIN, from the IRS. Financial institutions in Hawaii universally require this 9-digit number to open a dedicated commercial bank account, ensuring your funds remain segregated. Next, you must execute an operating agreement for an LLC or corporate bylaws for a corporation. Even if you are the sole owner, this internal document legally defines voting rights, member capital contributions, and exact ownership percentages. This internal documentation acts as the structural rebar inside your legal firewall. When a plaintiff tests your entity in court, documented governance provides the strength required to keep the shield intact. Once the entity is legally sound at the federal and internal levels, we must align it with the Hawaii state tax architecture. This brings us to the General Excise Tax, or GET. For mainland founders relocating to the islands, the GET is the most dangerous compliance trap on the board. Look at how these two systems weigh revenue. A traditional retail sales tax only weighs the final transaction with the end consumer. Hawaii's GET is a tax levied on gross receipts. It stacks and taxes every stage of business activity, both B2B and B2C, before expenses are ever factored in. This tax applies broadly. If you buy or sell items or provide services within the state of Hawaii, the GET applies to your gross revenue. To comply, you must submit the Basic Business Application, Form BB1, to the Department of Taxation. Accompanied by a $20 fee, this secures your GET license. Misunderstanding the mechanics of a gross receipts tax means underpricing your services. By failing to account for the GET, a founder can mathematically bankrupt their business before they ever reach a state of profitability. The initial $51 formation fee is nominal. The true cost of the corporate firewall is the mandatory, rigid compliance required to maintain it year after year. Every LLC and corporation registered in Hawaii must file an annual report with the Business Registration Division. Hawaii's deadline schedule is highly specific. Your report is not due on a uniform statewide date, nor the exact anniversary of your formation. It is due based on the calendar quarter in which your entity was originally registered. Filing this report online requires a $15 fee. If you miss this window, the state immediately updates your public record. Your entity loses its good standing status, halting your ability to secure loans, sign new contracts, or renew local permits. The liability shield requires strict, ongoing procedural compliance to remain active. Its protection lasts only as long as you maintain the state's registration requirements. The terminal consequence of prolonged noncompliance is severe. The state will ultimately step in and execute an administrative dissolution. Administrative dissolution instantly vaporizes the liability shield you built. It reverts you to the legal equivalent of a sole proprietor, bearing 100% personal liability for all existing business debts. A properly constructed entity does two precise things. It creates an impenetrable barrier around your personal assets, and it optimizes your legal tax obligations. A Hawaii business entity, when engineered with precision and maintained with discipline, provides the legal and mathematical foundation required to grow a business while insulating the founder from the risks inherent in the marketplace.